hear inflation talked about all the time, but what does it really mean? Today we'll dive into how inflation impacts borrowing, mortgages, and wealth building. We'll explore how your mortgage isn't just a liability, it's a powerful financial tool. Most of this information comes from the eBook provided by the National Institute of Financial Education. Please reach out to me if you'd like a copy. I'll share the book's insights on leveraging your mortgage to protect and grow wealth, even during uncertain economic times. Let's look at your house wealth, as that is greatly impacted by inflation. Your net worth is your assets minus your liabilities, and your house is often your biggest single asset and liability. As such, it plays a huge role in your wealth over time. Inflation tends to increase the value of an asset and decrease the value of a liability. When an asset goes up and a liability goes down, your net worth goes up even faster. For this reason, a mortgage can be one of the most important tools you have to maximize your wealth over time. Surprisingly, the longer your mortgage term, the more your mortgage payment and your mortgage balance are reduced by inflation. What is inflation? By definition, it's the loss of your purchasing power over time, and is usually measured against a large basket of goods and services. The Federal Reserve has a stated mandate to keep inflation at a target rate of 2%, which means they want assets to increase by around 2% a year. This mandate also means your purchasing power is reduced by 2% each year. What costs $1 today will then cost $1.02 in a year at 2% inflation. I like this relatable example of inflation. Say you used to weigh 200 pounds. In 2020, you gained 5 pounds, 11 pounds in 21. 22, you gained 9 pounds, 23, 6, and this year you only gained 3 pounds. So your weight gain is down, but you still weigh 34 pounds more than when you started. So when you hear it said that inflation is coming down, that doesn't mean things are getting cheaper. It just means they aren't getting more expensive as fast as they were. Let's look at the last 20 years. Using the Federal Reserve Consumer Price Index calculator, an asset purchased for $200,000 in the year 2000 would cost $315,233 in 2021 dollars. If you bought the asset in 2000 for $200,000 and it's worth $315,000 today, that feels good. If you want to buy that same asset that was $200,000 in 2000 and it cost you $315,000 today, that feels bad. Inflation is a monetary concept because the utility of the asset doesn't change, only the value. A house you bought 10 years ago for $200,000 doesn't offer you a 55% better living experience than the exact same house you buy today for $315,000. It simply costs more. The higher cost is considered inflation. The reality of realty is that real estate has outpaced consumer price index of inflation. The CPI has risen at a 3.33% per year since 2000, the red line. While Case-Shiller shows U.S. house values have increased 8.61% per year over that same time period, the blue line. The owner of a house asset feels wealthier as they have ownership in a typically appreciating asset, while the renter feels that appreciation as an obstacle to owning a house in the future. This appreciation gap also makes saving to buy a house more difficult. The house asset is larger and is inflating far faster than the savings balance for the down payment can inflate. Isn't paying interest a bad financial decision? Well, it depends. Let's differentiate between old dollars and new dollars. When you earn $1, you are always earning it now. It's a new dollar, and you know what you can buy with that dollar today. You don't know what it will buy you tomorrow, but if there is inflation, you know that new dollar today will buy you less in the future. And for that reason, you are better off spending that money now on something you really need or an investment that will at least keep pace with inflation. If you don't spend it now, that dollar becomes an old dollar. Old dollars typically buy you less as they lose purchasing power due to inflation. This is critical to understand, and one of the primary reasons we don't keep all of our money in a safe in the garage. We need old dollars to earn new dollars to hold purchasing power for the future. Mortgage debt works in the opposite way. We borrow money today in new dollars to buy or refinance a house today, and we sign an obligation to repay that debt with new dollars in the future. The day after we borrow those new dollars, the debt is now in old dollars, fixed in the past. We get to repay those old dollars with new dollars from our future. Remember, if there is inflation, it costs less to repay old dollars with new dollars. When we buy a house in today's dollars and borrow money in today's dollars, the house payment seems expensive now, but over time it becomes less of a burden as we continue to earn from our careers in new dollars. Let's look at an example. In this example, a couple buys a $500,000 house with a $100,000 down payment, securing a 30-year mortgage. And in the book, they were able to get that at 4% interest rate. It assumes inflation averages 3%. Their income of $100,000 today means their payment of $1,910 per month is 23% of their income when they first purchased the house. They could rent a similar house for $1,500 a month, but that rent goes up with inflation, and by year 10, their rent payment is more than the house payment. At the end of their mortgage term, they now own an asset worth $1.6 billion and no mortgage payment, versus the renter who is now paying $3,600 in rent. Of course, this illustration isn't taking into consideration the potential income tax savings from having a mortgage. When you understand the power of inflation, you realize that having a long-term mortgage that you can afford now will lead to a mortgage you can more easily afford over time, as inflation reduces your cost of borrowing. You lock your debt as a fixed amount of old dollars that you repay with new dollars. A renter will likely pay a variable rent payment that increases as their rent is always paid in new dollars. To recap, inflation impacts both assets and liabilities, and for most people, their home is on both sides of the balance sheet. Lock in a long-term fixed-rate mortgage you can afford now and let inflation reduce its real cost over time. Reach out and let's discuss your situation and financial goals. As with most financial decisions, the right answer is, it depends. So let's deep dive into your plan.